Most people don't invest in leverage ETFs because of the myth and misconceptions regarding leverage ETFs. But these leverage ETFs can bring you generational wealth. As I'm going to show you in this video, if you have invested, for example, $3,000 in the TQQQ 15 years ago, you'll now have $1 million. So in this video, I'm debunking 10 different myths about leverage ETFs. And after you're watching it, you have much better understanding. You'll be much more ready to invest in these ETFs. These myths have been destructive for investors, but not anymore, because after this video, you'll be much better informed to invest in leverage ETFs. All right, let's get into it. And the myth number one is that leverage ETFs are only for short-term trading, not for long-term investors. And that's so wrong. I always roll my eyes when I see anyone saying that leverage ETFs are only suitable for short-term trading, because that's a recipe for disaster. If you do short-term trading with leverage ETFs, you are guaranteed to lose money unless you have a crystal ball and you can perfectly time the market. However, according to my backtestings and according to a ton of information that I have collected, I have run thousands of backtestings, okay, and Monte Carlo simulations. If you invest for a period of 1 year, you have 66% probability of making money. 5 years, 82% probability of making money. 10 years, 91% probability. 15 years, 96% probability. So does this sound like leverage ETFs are for short-term or long-term, right? And I know that when you read the prospectus of these ETFs, it says that you should only hold them for the short term, but that's legal CYA. It's legal cover your ass. In this case, the ETF issuer, they're trying to cover that ass. Let's jump here on the computer because I want to share also some charts with you, okay? So if you have invested over the last 15 years in the SPY, we have made around 800%. That's just 1x leverage S&P 500. But if you have invested with 2x leverage, the SSO, you made 3,200% return. Does this look like you cannot invest for the long term? UPRO, the 3x leverage, gave you 7,800%. By the way, you can probably notice that 2x and 3x leverage will not return 2 or 3x the returns. It returns much more because of the compounding effect that is compounding over compounding with leverage. In the TQQQ, one of my favorite leverage ETFs, returned 32,000%, 32,000. It's pretty crazy. Also, I want to share with you this paper, Leverage for the Long Run by Michael Gayet. And let's scroll down here, and what we can see is that he backtested leveraging from 1928 until 2015, the S&P 500. And the results are very impressive. If you have invested from 1928 until 2015 with 1.25x leverage, so just a little bit, you actually return 4 times the S&P 500. With 2x leverage, you return 86 times the S&P 500, and 3x leverage, you return 290 times. So it says here that this clearly illustrates the point that there is no natural form of decay from leverage over time. The idea that leverage is only suitable for short-term trading is false when looking at how daily leveraging can perform over long-term cycles. So, myth debunked, you should not use leverage ETFs for short term, you should only use them for the long term. Myth number 2, volatility decay will destroy your portfolio. The myth of volatility decay is that the volatility decay will eat up your returns and you will just lose money over time. But again, according to the charts that I've shared with you, does it look like volatility decay will eat up your returns? Let me be clear regarding the volatility decay. Volatility decay is a reality, okay? If the market drops by 10%, now it needs to go up 11% to go back to the same level, right? And if you are using leverage, you will amplify these market movements. But the thing is that the stock market, especially the US stock market, if you are investing in ETFs related to NASDAQ and S&P 500, stock market goes up over time. You have 100-something years of data, and the stock market goes up on average 10% a year. So it's biased to move upwards, okay? And the volatility of indices is usually not so large that you cannot use some leverage to maximize your returns. Let's jump here on the chart again. And what I want to show you is my Kelly criterion curve. So the QQQ is the 1x leverage, and then you have QLD for 2x and the TQQQ for 3x, right? And what you see here is my Kelly criterion curve, it shows that beyond a certain point, you will have volatility decay, okay? So beyond the 3.6x leverage, you'll definitely 100% have volatility decay. That's why this curve goes down, because your returns are going down, okay? But if you use less than this leverage, you have the optimal leverage in order to get the best returns and the volatility not eating up your returns, okay? So typically, you have this optimal sizing, which you can see here. It goes up to 2.5, between 1.25 and 2.5. So if you are a bit more conservative, you can go to 1.2, 1.3x leverage, and you can achieve these by mixing a 2x leverage ETF such as QLD with some cash, for example. Or if you want to have a 2.5x leverage, you can mix 2x with 3x leverage ETFs, for example, and achieve this optimal leverage. So myth debunked, volatility decay will not eat up your returns if you are using the right level of leverage and if you are investing in the markets that go up over time, which is the case of the US stock market. Myth number 3, 3x leverage always means 3x the returns. And no, this is very, very incorrect, okay? These leverage ETFs rebalance every day. So they promise only to deliver 3 times the daily returns of the underlying. So if you are investing, for example, in the TQQQ, you will get 3 times the returns of the QQQ, of the 1x leverage. If you are investing in UPRO, you get 3 times the daily returns of the S&P 500 or the SPY. And over time, this will be very, very different from the actual returns of the index, okay? It can be much, much better or much worse. Now, let's jump here on the chart because I want to show you 2 different examples of bear markets and bull market, okay? So the first example that you can see here is 2022. In 2022, the QQQ dropped by 33%. 3 times 33% will be 99%, right? So was TQQQ supposed to go to 0? And no, the answer is no. Actually, leverage ETFs will give you some downside cushion, okay? Because they will, on the way down, because they rebalance daily, precisely because of the fact that they rebalance daily, they cannot go to 0 unless the index goes to 0, okay? For the TQQQ to go to 0, this index literally needs to go to 0. So what we see is that while the QQQ dropped by 33%, the TQQQ dropped by 80%. So less than 3x, right? This is very interesting finding. What about 2023? Okay, let's look at the bull market of 2023. And the findings are also very, very interesting. So in 2023, let me get the dates right here. Yes. In 2023, QQQ went up by 53%, while the TQQQ went up by 190%. 190% is much more than 3x of 53%. 3x 53% will be what? 160%, and actually you got 190%. Because when the markets go up, you get this snowball effect that is brought by these leverage ETFs. And because most of the time you're actually in the bull market, 90% of the time the US stock market is in the bull market, 10% in the bear market. So most of the time you actually have this very nice snowball, compounding snowball that will bring you much more than 3x, okay? And this is also why over even more prolonged periods of time, you get much more than the 2x or 3x that these ETFs are supposed to deliver. Again, the QQQ over the last 15 years returned 1,700%, while the TQQQ returned 36,000%. Like, how many x is this, right? Not 3x. Myth number 4, more leverage is always good if the market goes up. And no, that's very wrong, because you need to have into account the volatility. For example, sometimes people ask me whether they should leverage Bitcoin. If Bitcoin goes up, why not leveraging Bitcoin? And the answer is that Bitcoin is so volatile that a 2x leverage on Bitcoin can get you liquidated and you can lose everything, okay? Or if there is a 2x leverage ETF for Bitcoin, you can in this case can literally go to 0, okay? And that's what happened actually in October, November 2024. I had some friends that were using 2x leverage using a margin account on Bitcoin, and they lost everything. So you probably have seen these charts that I'm sharing here, and also my Kelly criterion curve. But basically, S&P 500, the optimal leverage will be 3x since 1950 until 2009. So we have here a very prolonged period, right? We had here a 60-year period, and actually if you have continued doing this leverage until 2026, so we have like over 70 years of data here showing us that 3x leverage will be optimal, but 4x, 5x, 6x will destroy your portfolio. So even if markets go up, you cannot use too much leverage because of the volatility. Now, myth number 5, you can lose everything in a big crash. And that's a myth, and no, you cannot lose everything. Sometimes people ask me, oh, what if the market drops by 34% and you are using 3x leverage, you lose 100%, right? No, wrong. So there are a few reasons why this myth is easily debunked. First, in the US stock market, we have circuit breakers. And if the market drops then more than a certain level, they halt the trading for a period of time. If it drops even further, they halt the trading for the rest of the day. And you never ever in the history of the stock market had a 30-something% drop either, even if you didn't have the circuit breakers, because before the circuit breakers, there was never such huge crash, not even during the Great Depression. So no, you cannot have one single day going down by 30-something%. And to be honest, if this happened, it's better you have like canned foods and gold bars and guns and bullets, because that's going to be needed. Because if that happens, it's like literally the end of the world. Forget your investments. Also, very important, leverage ETFs gives you intrinsic leverage. You are not using a margin account of a broker. And if you were using a margin account of a broker, you can lose everything. You can owe money to the broker. And that's not the case with leverage ETFs. Finally, as I have shown you before, during 2022, the QQQ went down by 34-35%, while the TQQQ went up by only 80%. So it's not the 3x. The math is quite different from that. So, myth debunked. Myth number 6. Leverage ETFs are the same as using a margin account. No, it's very different. Again, as I just said, you cannot be liquidated. You cannot have a margin call with leverage ETFs. Also, the cost of borrowing is much, much different, okay? Margin accounts are expensive, okay? You can pay 5-6% for the money that you are borrowing to get the leverage in the market. While leverage ETFs, because they don't achieve the leverage by borrowing money, they actually achieve the leverage by using derivatives and futures and options. The leverage is much cheaper, and they only charge you the expense rate, which in most cases for leverage ETFs is like 0.8, 0.9% a year. So actually it's a very, very cheap form of leverage. So myth debunked. Okay, next, myth number 7, 3x leverage means 3x the risk. As we have seen before, leverage ETFs can give you better risk-adjusted returns. What we are interested is for each unit of risk that you are taking, we get this amount of return. You want more returns than risk, okay? If you get more volatility, more risk than the returns, then it doesn't make sense. And that's why we use the Kelly criterion curve, and that's why you need to be at a certain level of leverage. Not much more, not less, okay? And what I want to share with you here in my Quantic platform is this. So for the S&P 500, for the last 10 years, the optimal leverage would have been around 3.56, okay? And you don't need to use exactly the full Kelly. If you actually use half Kelly, as you can read here, half Kelly will be approximately 2x, and this halves variance while keeping 75% of the growth. So meaning basically that if you use a 2x leverage on leverage ETFs for the S&P 500, which will be like an SSO leverage ETF, you have half of the volatility of UPRO. Okay, while you keep 75% of the growth of the full leverage, full Kelly UPRO, okay? So, myth debunked. Myth number 8, leverage ETFs have these crazy hidden fees, and they are too expensive. And this one really makes me smile, because I have seen experts, financial experts, on podcasts and TV saying that leverage ETFs have these hidden fees, blah, blah, blah. And it's all BS. They are all wrong, okay? Because they didn't look at the data. So they claim that because leverage ETFs, they need to borrow money, they need to have all these financial instruments, they're actually charging hidden fees that can go up to 10 or 15% a year. And that's very incorrect. So I never trust anyone, including myself. I don't even trust myself. I build the tools and I look at the data to see whether I'm right or wrong, okay? So everything I say and claim is based on data. Let's look at the chart. So I have created an indicator to actually tells us what are the real costs of leveraged ETFs, okay? And in this case, we are looking at the real cost of UPRO, the 3x leverage ETF for S&P 500, over the last 10 years, okay? And I know there are lots of numbers here, but the main thing is here. Total deviation, 15%. So there are tracking errors. So basically, over the 10-year period, okay, you got 1.5% annually less than you were supposed to get with the real 3x leverage with the daily reset of these ETFs. So at the end of 10 years, you have an extra cost of 15%. It's not 15% per year, it's 15% at the end of like 10 years. And in fact, according to my research, what you can see here at the bottom, you have beneficial, favorable asymmetry. What I have noticed, what I have studied in these leverage ETFs is that when you have down days, when you have bear markets, and when the market goes down, these leverage ETFs actually charge you a little bit less fee or give you a little bit less leverage. So according to my observations, when the market declines, for example, UPRO will give you a little bit less than 3x leverage. They will give you 2.98, for example, x leverage. So actually have more downside protection, and actually this downside protection is more beneficial than the deviation or the extra costs or the tracking errors that these ETFs have. Pretty cool, right? So myth debunked. Myth number 9, young people should not use leverage. It's quite the opposite. If you are young, you should increase your leverage. Why? Because at the beginning of your life, you don't have that much money, but you have human capital, right? You can generate money through your salary and you can continue investing throughout your life. So at the beginning of your life, you can actually increase the leverage to increase your exposure in the market and then decrease this leverage over your lifetime. This is called life cycle investing. And it's covered in this book, amazing book I highly recommend, called Life Cycle Investing, a new, safe and audacious way to improve the performance of your retirement portfolio. And this book argues that actually using leverage will reduce your risk. Quite counterintuitive, right? Leverage will reduce your risk. Why? Because at the beginning of your life, right, you don't have that much money to invest. And you can increase your leverage in order to increase the returns. And then over time, you decrease your leverage. And at the end, when you are like 50, 60 years old, 70 years old, you can have like just 1x leverage and you'll have much more money and you diversify it over time thanks to that initial higher exposure to the market using leverage. I also teach about this strategy in my ETF course, my 5-hour-long ETF course, which you can find in the Henrik Wealth Academy. You can find the link in the description. 7-day free trial, no questions asked if you cancel, but please join and take a look at the leverage ETF course where I talk about different investment strategies for leverage ETFs that can generate like amazing results, trust me. Finally, myth number 10, you need to time the market exactly in order to profit from leverage ETFs. And no, timing the market, it's a fool's errand. No one in the world can time the market exactly. Forget timing the market, okay, forget waiting for pullbacks and so on. The best strategy to invest in leverage ETFs is DCA, dollar cost averaging, period, okay? I have made a tons of backtestings, I have made videos about these strategies, and if you just put aside, I don't know, if you can save $1,000 per month, put aside $500 to put into ETFs, and you blindly put every single month a little bit into ETFs. You don't try to time the market, don't try to do anything, just put the money that you put aside every month into leverage ETFs. DCA, pure DCA, is really one of the best strategies that you can have. Now, I teach other strategies, like my counter-cyclical strategy, where you increase or decrease leverage according to the market cycles. I teach about the BD Collins strategy, where you invest 20% every month, 20% of your savings capacity, and you leave the other 80% in order to buy the dip. And I also help investors to do DCA according to certain indicators, such as the 200 MA. But really, some of the best investment strategies ever is not about timing the market, it's just keep it very simple, keep it very consistent, and after a few years, you'll be very happy. That's it. And you can sleep well at night. Alright guys, I hope after debunking these 10 different myths, you are much better prepared to invest in leverage ETFs. Check my other videos because I'm talking about this stuff every day. And I want investors to be better informed and to invest correctly in leverage ETFs, alright? Okay guys, if you enjoyed this video, give it a like and subscribe, and I'll see you very soon. Bye.